Hi, I'm Chris Nelson. Welcome to the Market Week in Review for the week ending February 13th. We'll cover the jobs report, the election outcome in Japan, and the tech stock market action. Let's start with the January U.S. jobs report, which was a positive surprise. Payrolls rose by 130,000 in January, a clear step up from 48,000 in December after revisions, and well above expectations. The unemployment rate also fell to 4.3%, an encouraging and historically low level. But the mix is the story. Job growth was concentrated in healthcare and social assistance, which continued to add consistently. Construction also contributed. On the other hand, we saw modest job losses in higher-paying segments like financial activities and in parts of the information sector, areas that investors tend to associate with stronger wage growth and white-collar demand. From a Fed perspective, we think this supports patience. If the economy is still adding jobs and unemployment isn't rising, it's harder to argue that interest rates are meaningfully restricting activity. Markets did react, though. Gold extended its pullback as the stronger labor data tempered expectations for near-term cuts. In short, job growth was better than feared, but the composition left some uncertainty around the outlook. Moving to Japan, the big development this week was the election outcome and what it implies for fiscal policy. Japan's Prime Minister, Sanae Takaichi, and the ruling bloc won a supermajority, giving the PM a mandate for stimulus, tax relief for consumers, investment in strategic industries, and higher defense spending. Investors have had some concerns about how this additional spending will be financed. Japan's debt load is already large at more than 200% of GDP. So does this mean more borrowing, higher yields, and yen weakness? Well, the market reaction was more constructive than cautious. Japanese equities surged to fresh records after the win, JGB yields edged higher, and the yen actually firmed modestly, which tells you investors aren't pricing significant fiscal concerns. The takeaway? Investors are embracing the growth impulse while watching the bond market closely. And on valuations, after last year's run, Japanese equities look less cheap than they did, but the market still has a tailwind if reforms, CapEx, and shareholder focus stay on track. Finally, a word on tech. After dominating last year, tech has lagged as investors rotate out of the most expensive AI-related names. Unease over high valuations, spending plans, and growth rates were amplified by recent CapEx announcements. Indeed, the big four, Amazon, Alphabet, Meta, and Microsoft, are on track to spend over $650 billion in 2026, a 60% increase from 2025. Beyond that, investors are keying in on who gets paid and who gets disrupted, and some software names have sharply corrected. When we compare what active institutional managers are saying, three themes stand out. First, the biggest, most established software programs still have real advantages. They're already embedded in large companies, and many managers believe AI is more likely to add features and expand spending over time than instantly replace these systems. Second, investors are becoming more selective. They're looking for businesses that are harder to replace. The plumbing of technology, think back office like accounting, infrastructure, and other critical tools. Third, the risk case is also straightforward. AI could compress profit margins if it makes software easier to copy, harder to price, or less sticky. In other words, some software companies may find it tougher to keep charging the same way they have in the past, particularly for seat-based models. Investors are watching a few simple signposts. Are companies actually deploying and paying for AI at scale, or is it mostly hype? And is AI driving new spend? Can revenue grow more without seats? We'll see. You could say that the market is reacting like a judge at the Winter Olympics. Strong routines get attention, but medals go to execution. Thanks for listening.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.